Good morning, everybody, and welcome to this edition of our Weekly Think Tank for Feb 15. My name is Carl Capolingua, and I'm the market analyst over here at ThinkMarkets. It is a pleasure to be with you as we delve into all the goings-on from last week and have a look to the week ahead. We'll do that after we talk about the ThinkMarkets Difference, which is substantial, $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees. Four fantastic reasons to make sure your next ASX share trade is with us. The agenda for today is to have a look at all the key market moves from last week, check out what's going on with the COVID situation, have a look at some of the key macroeconomic data from last week as well, see what the brokers are saying about the half-yearly earnings season, which is in play at the moment, have a look at some of the value insights, some technical analysis, and then a look to the week ahead. Kick off by looking at the market moves, and we can see about a 0.5% decline for the ASX 200 last week. Looking within the sectors there, the discretionary sector, not too good, 1.4%, call it 1.6% for energy. We did see really pullbacks in those sectors after strong performances the week before. Financials, I think, really in the same boat there, more a pullback than anything more severe. Gold was up, that's more of a bounce. Then I guess, outperformance, because that was down sharply the week before. Material sector up on some pretty strong moves in commodities markets. We saw industrial metals up sharply. We'll talk about that a little bit later on. Property trusts and utilities tend to underperform when interest rates are on the rise, and they did rise last week. So the 10-year Australian bonds hit 1.27%, and the US 10 years hit 1.21. Doesn't sound like a whole lot, does it? 1 and a bit percent. But those yields are actually the highest we've seen since the start of the crisis. And inflation expectations, which is driving a lot of this, is actually the highest we've seen since the Lehman Brothers collapse. So that's a major tectonic shift there. And we know since that Lehman Brothers collapse, central banks have been flooding the market with liquidity. The local volatility index popping up 9%. Telecommunications doing well, bit of a pop-up in Telstra. They reported their half-yearly earnings. Revenues were down, profits were down, but Andy Penn, the CEO, they're quite bullish about their prospects going forward and said that their TowerCo spin-off not far away, and that helped their share price. The ASX 200 chart shows, a few pretty average bars on the last 4 trading sessions of the week, hence that small 0.5% fall. Overall, though, the trend still remains up in the short term. It remains up in the long term. We have this really fantastic base pattern through here. I haven't drawn that very well, but it will support prices going forward and give us what I think will be a nice launching pad to push into those old highs from 71.97. Now, that was set back on Feb 2020, and that puts us 5 days away from our 1-year anniversary. So think about where you were back on Feb 20 last year. It was a different world, wasn't it? It's been 1 year, just about. Have a look at global markets. Nikkei up 4.16%. Now, that is one of those global markets that really benefits from this reflation trade. So when there's reflation, quote-unquote value stocks, so banking, cyclical stocks, the Nikkei very rich with those and outperforming as a result last week. Shanghai Composite and Hang Seng was closed for Chinese New Year holidays, so they are actually the week before's performances. The Dow Jones, S&P 500 and NASDAQ up anywhere between sort of 1 and 2%. US volatility index coming down, that's encouraging. It does highlight, however, the underperformance of the Australian market last week. FTSE up about 1.5%. DAX was pretty flat, but that market looks very, very good indeed. And the CAC up about 0.78%. This was the reason for our materials sector doing so well last week. 3, 4, 5, almost 6% gains in some of these industrial metals. I'm noting there a nearly 6% gain in iron ore in China. I've got a very interesting chart for you coming up on the COVID situation in Brazil, and I'll save that for a minute or so. Gold and silver up slightly as well. The energy complex doing quite nicely. The Australian dollar surging 1% as the US dollar eased back again. And as suggested earlier, we did see those bond yields on the rise. Having a look at how we're tracking this time versus last time. Well, this time it's the light blue line. That's the current quote-unquote crisis, and last time is the GFC crisis. That's the orange line. And hey, they say history doesn't repeat. We can see here it clearly rhymes. And if last time's anything to go by, it'll be interesting to see how we perform in a few weeks' time when we get to this bit here. But otherwise, tracking along very closely. And fortunately for the world economy, it looks like we're on the right side of this current crisis. US cases of COVID, this is a 7-day rolling average, back below 100,000. That's a major milestone. It's fantastic to see. We haven't been here since really the start of November last year. Europe a little bit higher, but obviously we're looking at a larger population overall. I talked about that interesting chart from Brazil, and this is Brazil COVID cases here. And just in preparing this over the weekend, I noticed that this chart looks suspiciously like the chart of iron ore. And it makes a lot of sense. Brazil is the second largest global producer of iron ore after Australia, of course. And if they have had some significant impact on that industry from COVID. So with COVID cases taking a turn up, that does threaten supply. And therefore we're seeing a bump back up in iron ore prices. But the top was made at roughly the same time on the Brazil COVID cases as it was on the iron ore prices in China. So, worth keeping an eye on that one going forward. Having a look at some of the economic data from during the week. The Now Business Confidence Survey showed quite a substantial drop-off in current conditions. So we can see the previous current conditions there, 15.79, and the current reading of 7.16. That's how businesses are feeling they're going at the moment. But it was good to see that we saw a big jump in business confidence, that one's looking forward. How are we going to be going in the future? They are the red and green bars, and we're seeing, I think, a nice uptrend there. But again, that dip in conditions. And that was due to the fact that we did see some spot lockdowns in a number of states during that sample period. But fortunately, it looks like we're getting those situations largely under control, and hence the improving confidence. Have a look at the consumer sentiment. We saw a bit of a flattening in the curve there, all for the same reasons, but we do remain at elevated levels, so that is encouraging. Heading over to China now, and we had some data on M2 money supply, and this is the amount of money sloshing around in the Chinese economy. We've seen a bit of a downtrend through here, and that signifies, I guess, basically taking a little bit of the foot off the accelerator and some of the stimulus they're providing. Down the bottom, we're looking at new loans. So this is less about, I guess, what the public sector is doing and more about what the private sector is doing. Having said that, there's no real such thing as private sector in China. But certainly new loans on the way up, and that has contributed to a big spike in indebtedness in the Chinese economy. So that's risen to about 280% of GDP, and it certainly did get the attention of the central bank governor. His name is Yi Gang, and he said that, look, it probably would become under control, but it is on the radar for the Chinese central bank. That probably explains why the M2 money supply is on the way down. Having a look at inflation levels in China, this is consumer price inflation heading into negative territory there. The wholesale inflation, not shown on screen, did pop up a little bit, but you're looking at the Chinese inflation rate pre-COVID versus post-COVID. It does give that central bank, despite that high level of indebtedness, some flexibility in continuing to support the Chinese economy. Having a look at the equivalent data in the US, the consumer price inflation on the left and the wholesale inflation on the right came in very, very low indeed. In fact, 0% on the consumer, 0.1% only on the producer side of things. So not market moving there, but does also give the Fed some ability to continue with their accommodation. Have a look at weekly jobless claims. The expectation was a print of 755. We came in at 793. That was still down on the previous number, which was revised higher to 812,000. There was some good news, however, on the number of continuing claims. They fell, just looking at my notes here, 145,000 to 4.5 million. But there are still over 20 million Americans claiming some form of unemployment support. And that is just a clear example of how much damage this COVID pandemic has done to their economy. Having a look at the University of Michigan Consumer Sentiment Survey, don't forget, consumer spending represents about 2/3 of GDP, so it's a really important number. And we saw a drop from 79.2 previous to 76.2, and it was actually below expectations as well. And we can see with the more severe impact that COVID has had on the US economy that compared to Australia, we saw the Westpac Consumer Sentiment Survey, almost a V-shaped recovery. US consumers have been relatively more subdued. But hopefully with that improving COVID situation over there, hopefully with the vaccines being rolled out, we can see an improvement there and some significant support coming through for the US economy later in 2021. Have a look at some of the market news from last week and the broker reactions to that news. News Corp came out with their second quarter earnings report, well ahead of expectations. Certainly at UBS, they retained their buy rating, increased their price target from $29 to $32.20. You can see, looking at the share price, around about $30 at the moment. They're still seeing some upside in it. They said that the company was delivering on their cost-cutting program and increasing their operational efficiencies, and they remained optimistic about the future growth prospects, particularly in their digital operations. Macquarie Bank raised their price target a huge amount, $25.55 up to $36.10. So it's still a 20% upside seen in it from Macquarie Bank. Retained their outperform rating. They were very impressed with the second quarter results, so much so that they raised their expected earnings for FY21 by 47%, 41% for FY22 and 27% for FY23. Looking at the broker consensus for this one, and it's all one-way traffic here, 6 buys, no holds, no sells, no strong sells. We've got a mean target of about $30, but you can see some of the upside expected here potentially. And probably, given that it takes a few days to update these things, we know there is a higher one than that. So maybe there's even some catch-up to come here. Looking at the financials, we do have a pretty good enterprise value to revenue, showing that the company is generating fantastic revenues for what the overall market capitalisation is. Having a look at the PE, though, you would hardly call this stock cheap. 53 for FY21, dropping to about 38.52 in FY22, and that is because the growth is actually very good for this one, but it's not cheap at this point in time. The dividend yield is only about 1%. That's not exactly shooting the lights out either, and return on equity, because it's such a capital-intensive business, is not fantastic. I must admit I'm struggling to see from the fundamentals what the brokers are seeing in it, but certainly looking at the technicals, I can't fault this one. It's bottom left, top right. It is an absolutely outstanding chart. The short-term trend clearly up, long-term trend clearly up, and whilst it has had a very good run, I would still like to be a buy if we do see pullbacks into this range here, and it's probably going to be that sort of 28, 27 range where you're starting to get a little bit better value for a potential move back up into that 30 level and beyond. Not doing so well last week was AMP. So the insurer and fund manager reported a 30% drop in their underlying full-year profit on Thursday, and their $177 million profit for the year through to December did get them back into profitability after the headline $2.5 billion loss the previous year, so that's a small positive. Revenues were down, fund flows not heading in the right direction, unfortunately, and in addition to that, around late October last year, so that's right here, there was a takeover bid thrown on the table, a non-binding takeover bid at $1.85 by Aris Management, and Aris pulled the pin on that pre-results, and you can see the big drop in the share price there. So not a lot going right for AMP. We saw Citigroup lowering their price target from 160 to 145, retained a neutral price target. They weren't happy with the company's investment earnings in those FY20 results. They lowered their expected earnings for FY21 by 16%, FY22 by 19%. So compare that to News Corp. They said that the turnaround is slow going and dividends will remain under pressure. Some asset sales would help the business. Macquarie upgraded their rating from underperform to neutral. That's an interesting one. Raised their price target from 130 to 145, which is about here. Notes that the withdrawal of that Aris Management takeover I talked about has overshadowed the full year results, which they said weren't that bad. And with the takeover bid gone now, they can focus on turning this business around. The results made the path to recovery a little clearer for them, and they upgraded their earnings forecast. And finally, we've got UBS, who lowered their price target from 180 to 145. Big drop there. They did retain the neutral price target. They were not impressed at all with the full year results. They were 3% below forecast, led by a 12.5% decline in performance at AMP Capital. The broker feels that risks remain to the downside, and so do a few other brokers. 5 holds there, 1 sell, only 1 strong buy. Not sure who was brave enough to do that. Mean estimates at 165 does provide a little bit of upside, but again, potentially there may be some catch up here. In terms of the valuation, that looks pretty awful. The PE is not too bad though. PE growth rate's not terrible either at 0.86. Dividend yield, I did read that they are looking to reinstate their dividend in the not too distant future. So that's probably going to be a tangible dividend yield. Otherwise, not all too impressive down here. So looking at those fundamentals, look, they're hardly what you call exciting. I'd certainly not going to rush out and buy AMP shares on the basis of that. The broker recommendations aren't inspiring me all that much either. Looking at the chart, that's probably the least inspiring thing of the lot. Short-term trend has once again turned down. Long-term trend was already down, and well, maybe if you really squint, there's a little bit of support here at 130. So I don't think I'm a buy there anyway. So it's probably just a wait and see on AMP. Have a look at where the value is in the Australian market, or if there's value in the Australian market. Well, the overall market PE is about 19.59. That compares to global PE of developed markets of 21. So we are, very much cheaper than the rest of the world, and that degree of cheapness is expanding. Even so, even though we're a little bit cheaper than the rest of the world, you'd hardly say that 19.59 is cheap. So typically, you're looking at 20 tends to be expensive, 15 is sort of fair value, and anything around 10, you're starting to be cheap there. And that's just looking at big broad averages. And worth probably assessing this next slide on that basis, so we can see things that are looking pretty cheap, material stocks, and we know that with those surging commodity prices, that reflation trade going on, they're going to start to look pretty attractive. Financials, probably closer to fair value than cheap, that's for sure. And then the next one is property at 17.1, energy at 19.3. And from there, you start to get over 20 into the quote-unquote expensive area until you get to eye-wateringly expensive with information technology, which benefited from that buy now, pay later rally last week. Having a look at the technicals, so this is how many stocks are participating in the current market rally, and we've seen some pretty wild gyrations over the last few weeks. This is the third week in a row we've been swinging between sort of 30 and 70% of stocks in those short-term trends, and that can happen when you're very close to those trend lines and you're getting those even small moves up and down will take you above and below it. So looking a little bit further out, and this is from 3 months onward, that's been fairly stable. So I think that's encouraging. Obviously, we'd like to see the line as flat and as high as possible. Looking at the green line, that's your Feb 20 highs from pre-COVID. Looking at the red line, that's your March 20 lows, so at least we're well above that. And then we've obviously got the 1 month ago, you can see pretty consistent with that. So whilst there has been some short-term volatility, the majority of stocks are participating in this rally, and that is encouraging. Having a look at the week ahead in terms of economic data, by far and away the biggest one locally will be the unemployment change. Everything's going to pale in comparison to that one. That's Thursday at 11:30 a.m. Heading to the rest of the world, we will have retail sales in the US. I said earlier on, about 2/3 of GDP is consumer spending, so hence why that's so important. And heading into the sort of latter part of the week, the FOMC meeting minutes from their last meeting, that's the Federal Reserve meeting, and we get some PMIs for Europe and the US to close out the week. Well, that's it for today. If you'd like any other market updates and news, head over to the market news section of the website. You can follow me or the Think Markets handles on Twitter. Make sure you get onto the webinar section of our website and register for this week's Ask the Experts, where you can bring your portfolio along and I'll give you a quick fundamental or technical on any stocks you'd like me to talk about. Coming up after that on Wednesday, 24th of Feb, register on that webinars page also for 3 stocks with dividends and growth, and how to create an investing plan on the 10th of March. That's it for me today. Before I leave you, the disclaimer, which says everything we've discussed is general advice. At Think Markets, we are a regulated Australian broker, and we do have some products that could see you lose more than your deposit. So make sure you read this disclaimer carefully, or give us a call if you'd like to chat about it, or consult the website for further details. Thanks for joining me today. All the best for your trading. Bye-bye for now.